Dalal Street, India's financial hub, has experienced a rapid shift in investor sentiment. Previously, the market was characterized by a period of strong confidence among investors. This confidence has now transitioned into a more cautious outlook. The change reflects a significant alteration in the overall investor perspective. This shift impacts market dynamics and investment strategies. Such rapid changes in sentiment are common in financial markets. The market recently demonstrated strong performance, trading near its peak levels. This upward trend indicated robust investor confidence in the market's stability and growth. Positive momentum was a key characteristic of the market's behavior in the preceding days. Such conditions often reflect a favorable economic outlook and strong corporate earnings. The market's position near its recent peak suggested a period of sustained optimism. The prevailing market tone has shifted to a defensive posture among investors. Investors are actively reassessing risks across various global factors. Key influences include geopolitical developments and fluctuating energy prices. Global macroeconomic signals also play a significant role in this risk evaluation. Market sentiment is currently undergoing a significant shift. This change is directly attributed to escalating tensions in the Middle East. The geopolitical situation in the region has rapidly intensified. These developments have captured global attention across financial markets. The escalating tensions serve as an immediate catalyst for market volatility. The geopolitical landscape involving Iran significantly impacts global energy markets. Concerns surrounding the Strait of Hormuz are a primary driver of this impact. The Strait of Hormuz is a critical choke point for global oil and gas shipments. Any instability in this region can disrupt supply chains and increase energy prices. Such disruptions create significant ripples throughout the international energy sector. The Strait of Hormuz is a vital narrow shipping corridor connecting the Persian Gulf to the open ocean. It is recognized as one of the world's most strategically important choke points for global energy trade. A substantial portion of the world's daily crude oil supply transits through this strait. Tankers carrying millions of barrels of oil navigate its waters daily. Its geopolitical significance is immense, impacting global oil prices and international relations. Global oil markets are highly sensitive to geopolitical events and supply chain stability. Key maritime choke points, such as vital straits, are crucial for oil transportation. Disruption in these vital straits can significantly impact oil flow. Even the mere possibility of such disruption creates market uncertainty. This uncertainty often triggers a sharp increase in international oil prices. The perceived risk of supply interruption directly influences global oil market dynamics. India's energy security is heavily reliant on imported crude oil. The nation imports over 80% of its total crude oil requirements. This high dependency creates significant economic and strategic implications for the country. Understanding this reliance is crucial for assessing India's energy policies and future development. India's economy is highly sensitive to fluctuations in global oil prices. Oil is a critical input for various sectors, including transportation and manufacturing. Increases in global oil prices directly raise the cost of production and logistics. These elevated costs are often passed on to consumers through higher prices for goods and services. Consequently, a surge in global oil prices quickly translates into heightened inflation concerns. This dynamic significantly impacts the overall economic stability and purchasing power within India. Rising oil costs significantly influence global and national economies. For India, increased oil prices directly impact its import bill, as it is a major oil importer. This higher import expenditure creates a deficit in the country's balance of payments. Consequently, the demand for foreign currency to pay for oil imports rises. This increased demand puts downward pressure on the value of the Indian rupee. The rupee depreciates against major global currencies, affecting purchasing power and economic stability. India's current account deficit is significantly affected by its crude oil import bills. Increased expenditure on crude oil imports directly exacerbates this deficit. A widening current account deficit can negatively impact the nation's external financial stability. This economic vulnerability highlights the importance of managing import costs. The Nifty index is a key benchmark for the Indian stock market, reflecting the performance of top companies. Market reactions are often swift and direct in response to significant economic or political developments. Recent events have triggered an immediate response within the financial markets. This reaction is evident in the trading sessions of the Nifty index. The index has experienced a notable decline, indicating investor sentiment and market volatility. Such movements highlight the sensitivity of financial markets to external factors and news. The Nifty index recently experienced a significant downturn in market performance. In the latest trading session, the index declined by over 315 points. This drop brought the Nifty's value to approximately 24,450 points. The single-session fall contributed to a broader weekly trend. Over the course of the week, the Nifty recorded a cumulative decline. The total weekly loss amounted to nearly 3% of its value. Market movements are characterized by changes in asset prices over time. The magnitude of these movements indicates the extent of price change. Significant market movements can be observed through various financial indicators. Volatility refers to the rate at which the price of a security increases or decreases. A sharp increase in market volatility often accompanies substantial price shifts. The India VIX is a crucial index that measures expected market volatility. It is often referred to as the fear gauge for the Indian stock market. A higher VIX value indicates greater expected market fluctuations. Recently, the India VIX climbed to approximately 19.9. This increase signifies a heightened level of investor anxiety and uncertainty. Such movements suggest that market participants anticipate larger price swings in the near future. The VIX, or Volatility Index, measures market expectations of near-term volatility. It is derived from the implied volatilities of S&P 500 index options. A VIX reading approaching 20 indicates that traders anticipate increased market turbulence. This level suggests a shift from expected stability to potential market unrest. The VIX, or CBOE Volatility Index, measures market expectations of near-term volatility in the S&P 500. An elevated VIX level indicates increased market uncertainty and anticipated price fluctuations. This heightened uncertainty often prompts market participants to engage in hedging activities. Hedging involves strategies designed to mitigate potential losses in investment portfolios. Thus, a rising VIX suggests a surge in efforts to protect investments against adverse market movements. Market price fluctuations are often visualized through graphs, displaying asset value changes over time. These graphs indicate the volatility and potential instability within a trading environment. Wider price swings suggest that market participants anticipate greater uncertainty. This indicates expectations of significant price changes in the near-term trading period. Market sentiment is shifting, influencing various asset classes. The behavior of other asset classes reinforces this shift. Notably, gold is experiencing a strong surge in value. This surge indicates a significant change in investor perception and market dynamics. Safe haven assets are investments that typically retain or increase in value during market turbulence. These assets are sought by investors to protect capital during periods of economic or political uncertainty. Traditional safe havens often include commodities like gold, known for its historical stability. Other examples include certain government bonds or currencies, perceived as reliable during crises. The demand for safe havens rises as investor confidence in riskier assets diminishes. Capital rotation is a key dynamic in financial markets, reflecting investor sentiment and risk appetite. Geopolitical uncertainty often introduces instability, impacting global economic forecasts. When the economic outlook becomes cloudy, investors seek safer havens for their capital. This leads to a shift in investment patterns, moving funds away from riskier assets. Equities, or stocks, are typically considered higher-risk investments due to market volatility. Consequently, capital tends to rotate away from equities during periods of heightened uncertainty. An asset allocation shift involves repositioning investment capital within a portfolio. This strategic move aims to direct funds towards specific asset classes. The goal is to favor assets perceived as more stable or resilient. This reduces exposure to market fluctuations and potential volatility. The rally in gold prices often serves as a key indicator in financial markets. This phenomenon suggests a shift in investor sentiment and behavior. A sustained gold rally signals that global investors are becoming increasingly risk-conscious. Investors typically seek safe haven assets like gold during periods of uncertainty. This move away from riskier assets reflects a desire to preserve capital. Thus, gold's performance provides a subtle yet powerful signal about market confidence. The global macroeconomic environment currently presents a complex landscape. It is characterized by a mixed set of economic signals. These signals are observed by market participants worldwide. This indicates a period of uncertainty and varied economic performance. Recent labor market data from the United States has been released. The data indicates a notable shift in employment figures. Specifically, there's been a decline in payrolls. Approximately 92,000 jobs were lost. This decline reflects a significant change in the U.S. job market. The unemployment rate in the United States recently experienced an upward trend. It edged up to approximately 4.4%, indicating a shift in the labor market. This increase reflects a softening in the overall labor market conditions. A softening labor market suggests a decrease in demand for workers. This can lead to fewer job openings and increased competition among job seekers. The unemployment rate is a key economic indicator, reflecting the health of the economy. Under normal economic conditions, specific data points can influence market expectations. These data often provide insights into the potential trajectory of interest rates. When data suggests economic slowdown or stability, it can increase the likelihood of interest rate cuts. Lower interest rates typically reduce borrowing costs for companies and consumers. This reduction can stimulate economic activity, leading to higher corporate profits. Consequently, such data is often interpreted as positive news for equity markets, boosting stock valuations. The U.S. Federal Reserve, Fed, manages monetary policy to achieve economic stability. A key tool for the Fed is adjusting interest rates, influencing borrowing and spending. Economic indicators, such as the labor market, heavily influence these policy decisions. A weakening labor market signifies rising unemployment or slower job growth. This typically provides the Fed with greater flexibility to consider reducing interest rates. Market liquidity refers to the ease with which assets can be bought or sold without affecting their price. Lower interest rates typically lead to a decrease in the cost of borrowing money. This reduction makes capital more accessible for businesses and individuals seeking investment. Consequently, lower interest rates generally support increased market liquidity. Increased market liquidity refers to the greater availability of cash and easily convertible assets. This surplus capital often seeks higher returns in various investment opportunities. Risk assets, which offer potentially higher yields, tend to benefit from this increased liquidity. Emerging markets are particularly attractive to investors due to their growth potential. Consequently, greater liquidity attracts significant investment flows into these emerging markets. The global economic landscape is currently characterized by significant deviations from historical norms. This period presents a unique set of challenges that distinguish it from typical economic cycles. Factors contributing to this anomaly include unprecedented market volatility and supply chain disruptions. Inflationary pressures and shifts in consumer behavior are also major components of this unusual environment. Policymakers and businesses face complex decisions in navigating these uncharted economic conditions. Understanding these anomalies is crucial for developing effective strategies and ensuring economic stability. Stagflation is an economic phenomenon characterized by simultaneous weak economic growth and rising inflation. This condition challenges conventional economic policy, as measures to combat inflation can worsen stagnation. A key factor contributing to stagflation can be a sudden increase in the price of essential commodities, like oil. When weaker growth coincides with rising oil prices, markets become concerned about potential stagflation. Stagflation describes a challenging economic condition characterized by a combination of factors. It involves persistent high inflation, meaning a general increase in prices and fall in the purchasing value of money. Simultaneously, the economy experiences stagnant or slow economic growth. This slowdown in growth is often accompanied by high unemployment rates. Stagflation presents a difficult dilemma for policymakers, as measures to combat inflation can worsen unemployment. Stagflation presents a significant policy dilemma for central banks. It is characterized by simultaneous high inflation and stagnant economic growth. Conventional tools to combat inflation typically involve raising interest rates. However, such measures can further worsen economic growth by reducing demand. Conversely, policies aimed at stimulating growth may exacerbate inflationary pressures. Stagflation presents a unique challenge for investors, combining high inflation with stagnant economic growth. This economic environment creates considerable uncertainty regarding future interest rate movements. Investors also face ambiguity about the overall momentum and direction of the economy. Such conditions complicate investment decisions and risk assessment for financial markets. Equity markets worldwide are currently exhibiting increased caution. This shift is primarily driven by a pervasive sense of uncertainty in the global economic landscape. Uncertainty can stem from various factors, including geopolitical events or economic instability. Investors react to these uncertainties by adopting more conservative trading strategies. This leads to a general decrease in risk appetite across different markets. Consequently, equity markets begin to trade with greater prudence and reduced volatility. India's domestic economy demonstrates remarkable resilience despite global economic challenges. The nation's economic backdrop maintains relative stability amidst international headwinds. This stability is a key indicator of India's robust internal economic mechanisms. It reflects effective policy measures and strong domestic demand. The economy's performance contrasts with the volatility observed in other global markets. Such resilience positions India favorably in the current global economic landscape. The Reserve Bank of India, RBI, actively manages the nation's financial liquidity. This involves maintaining supportive liquidity conditions within the financial system. Consistent liquidity support is crucial for anchoring financial stability. These actions prevent market disruptions and ensure smooth economic operations. Policymakers are actively working to strengthen the banking system. The goal is to ensure the banking sector remains resilient against economic shocks. This resilience is crucial for supporting sustained credit growth. These measures aim to maintain financial stability and economic health. Governments implement policies to manage domestic fuel prices. These policies aim to maintain stability in the local fuel market. Stabilizing fuel prices helps to control inflation expectations within the economy. This is crucial even when global energy prices experience significant fluctuations. Such measures shield consumers and businesses from volatile international markets. The stability fosters economic predictability and supports overall economic health. The Indian equity market recently experienced a correction. This market adjustment was characterized as measured. It was not dramatic or widespread in its impact. This measured response is attributed to underlying domestic stability. Domestic stability acts as a buffer against significant market volatility. It helps prevent sharp and extensive market downturns. Investor sentiment in the Indian market currently reflects a degree of caution. Despite this caution, investors are not withdrawing from the market entirely. This indicates a sustained underlying confidence in India's economic prospects. The market demonstrates resilience, with continued participation from investors. Such behavior suggests a belief in long-term growth potential, despite short-term uncertainties. Therefore, investor confidence in India remains robust, even with prevailing cautious attitudes. India's economy exhibits a robust structural growth narrative. This narrative is widely perceived as fundamentally intact. Long-term economic prospects for the nation remain highly positive. This outlook is supported by underlying structural strengths. Recent corporate developments have brought legacy corporate debt exposures back into focus. Investigations linked to these long-standing financial obligations have resurfaced in headlines. This indicates renewed scrutiny on companies' historical financial liabilities. The reemergence of these concerns highlights potential risks within the corporate sector. Such developments often lead to increased market volatility and investor apprehension. Market developments, even if isolated, can significantly impact investor sentiment. These developments often amplify existing caution within financial markets. This amplification is particularly evident when markets face external uncertainties. Such events can exacerbate market volatility and risk aversion. The derivatives segment offers key insights into immediate market outlooks. Analysis of derivatives trading reveals specific strategies employed by market participants. These insights are crucial for understanding short-term market movements and sentiment. Derivatives data can indicate potential future price trends and volatility. Options positioning refers to the collective stance of traders in the options market. It provides insights into market sentiment and potential future price movements. This data indicates how traders are preparing for various market scenarios. Active options positioning suggests anticipation of price fluctuations. Traders often use options to define a specific trading range. This strategy allows them to capitalize on expected market movements within set boundaries. In financial markets, resistance and support levels are key technical indicators for price movements. Heavy call writing at 24,700 indicates strong resistance, where upward price movement is expected to halt. Significant put positions at 24,200 signal a support level, where downward price movement may reverse. These levels are crucial for traders to anticipate potential price reversals or consolidations. The Nifty index currently trades near the midpoint of established support and resistance levels. This positioning indicates a strategic tug-of-war between market participants. Sellers are actively defending higher price points, preventing significant upward movement. Conversely, buyers are absorbing dips, preventing substantial declines in the index. The near-term market outlook is characterized by significant volatility. This volatility is driven by a complex interplay of global risks. These global challenges are counterbalanced by domestic economic resilience. Competing forces create an environment of uncertainty for market participants. Traders are advised to remain nimble and adapt quickly to changing conditions.